Hey, everybody, and welcome back to Keeping Your Business on Track. I'm Joe Harris, your host, and I'm here with one of our top loan officers. Go ahead and introduce yourself.
Nic Nazon.
Nick, thank you for joining us today.
Absolutely.
What are we talking about today?
Well, we're going to discuss this new perceived tax on mortgages for people with higher credit scores, potentially paying higher fees than those with lower credit scores.
Okay, so is that the case?
No.
No? Okay. So let's talk about it. So this tax you're saying is Biden came out recently, our president came out and said that, they're putting this tax on mortgages to make mortgages less expensive for those with worse credit scores. Is that about it?
Somewhat, yes.
Okay. So is this true?
No.
No. What is the case?
The case is that the pricing it's a loan level pricing adjustment, an LLPA, and there will be a slight increase for those people with higher credit scores and a slight decrease for those with lower ones. But the people with higher credit scores will not be paying more than those with lower.
Okay, so go back a step. LLPA, loan level pricing adjusters. What is that?
A loan level pricing adjustment is essentially a risk factor that's taken into account when you're locking your loan, and it basically defines why your pricing is what it is.
Okay.
So credit score, loan to value, et cetera.
Okay, so they're pricing adjusters. If you have a higher loan to value, in other words, you're putting less down the loan, you're going to have a higher interest rate typically?
Potentially, yes.
Okay. And a credit score. Those are different. There's a different adjusters for credit scores?
Absolutely.
Okay. So if you have a higher credit score, are you going to have a worse rate than a lower credit score?
Absolutely not.
Okay. Maybe if the lower credit score is putting a lot more down, right? Potentially.
Yeah, it kind of bridges the gap. It's all risk-based.
It's all risk-based. So we're talking about risk-based pricing and adjustments based on your specific situation.
Correct.
So there might even be a scenario where someone's putting very little down with a high credit score.
Yep.
And someone's putting a lot of money down and have a lower credit score. There might not be a huge difference between that rate.
Correct. Yeah.
But the difference is to the risk.
Exactly.
Okay. So why are we hearing about this now? Why we're hearing about this now, I hear people in the news talking about it, and there's this Robin Hood tax, they're calling it, which, I mean, to be fair, it is to a degree. If you're having a pricing hit where you didn't used to have them, it's adjusting for the lower credit scores, right?
Correct.
But I got someone told me yesterday that they were going to get a worse credit score so they get a better rate. Is that the case?
Absolutely not.
Okay.
No.
So
way,
I shouldn't go out there and purposely damage my credit in order to get a better rate on mortgage.
Correct. Keep paying your bills.
Keep paying my bills. That is good. That's the best advice I got all day. So it wouldn't be practical to intentionally lower your credit score and to get a better rate.
No.
So is there misinformation in the media right now?
Absolutely. I think there's a bit of a spin, and that obviously tends to happen. But when you read into it, that's the Robin Hood tax isn't exactly what it's perceived to be.
So you're saying one side is using it to their advantage and the other side is using it to their advantage?
100%.
Okay. But going back to facts here, lower credit borrowers are not going to pay less than higher credit borrowers.
No.
Okay. So that's good. Any other comments on LLPAs or anything?
Yeah, I think it's very important as a loan officer, one, you understand the LLPAs, of course, and you also tell your clients why pricing is the way it is. It's always going to vary, obviously, but understanding just that little bit of if you put $5,000 more down, you're going to potentially get a better interest rate, or maybe you put that into the equity points, etc. But making sure that that's kind of your Bible, for lack of a better term. Like, you really have to understand that to better assist your clients.
So you're saying that not every loan is built the same?
Absolutely not.
And one client might need something different than another client.
Yeah, it's like a snowflake, more or less.
Okay. Well, we don't have a lot of time left, but thank you for joining us today. So let's just do our takeaways. Number one, loan level pricing adjusters. That's the risk-based pricing that the government-sponsored entities, Fannie Mae and Freddie Mac, that they impose upon the loans that are done with them. And about 60-70% of loans are done by Fannie Freddie?
Absolutely, yeah.
Yeah. So the mass majority of pricing is have this. Now, they said it takes into account on May 1st. The reality is this is a lot of people don't understand this.
Yeah.
That those loans It's when they're sold to Fannie Mae or Freddie Mac.
Correct.
So we've been pricing this in. The lenders have been pricing this in for months now.
Absolutely. Yeah.
And it's already in effect.
Yeah.
And so those are loans that are delivered to Fannie. So when we do a loan, it gets sold to Fannie and Freddie eventually. But when we locked this loan 30, 45, 60 days ago.
Yeah, exactly.
So keep your credit scores up. That's a good takeaway.
Always.
don't lower your credit score to think you're going to get a better rate on your mortgage. And any other takeaways you think everyone out there should have?
It sounds a lot more fearful than it actually is. So especially realtor partners, loan officers everywhere. If you have clients calling you in about it or sending you text message about the article, I've gotten plenty of them. Make sure you just educate them and kind of put them at ease. Because again, all the rates you've been quoted over the last 90, 60 days have already included this, like you just said.
Right.
And essentially, it's not a vice to get off the market, basically. Just keep on doing what you're doing.
Yeah, I mean, there's a lot of positive things going on in the market right now.
Yeah.
It's too bad that the media spends time trying to tear it down and break it down. And I'm bipartisan. It's both sides.
Yeah, exactly.
Right? They're both using it to their disadvantage to spin fear and all these things, or their advantage to spin fear and just make the other side look bad.
Correct. Yeah.
In the meantime, it's the borrowers that's suffering, that's thinking, well, now's not a good time to buy a home, and they're absolutely wrong.
Yeah. 100%.
Right? If they wait, we're getting a whole different podcast. But don't use this as an excuse to not buy a home right now.
Basically,
the rates are not going to be drastically different, and they are going to be different based on credit scores.
Yeah.
But your rate's going to be better with a higher credit score.
Correct.
That sounds pretty good. So keep doing what you're doing. If your credit score is low, bring it up. Work to bring it up. There's lots of things you can do.
Absolutely.
In the meantime, if you have any clients looking to buy a home, give us a call. Give Nick a call.
Absolutely.
If you work with a different loan officer, give them a call. And if you have any questions on this subject, please feel free to reach out to us, and we'll do the best we can to answer it. Otherwise, like, share, comment, and we'll see you next time.
Absolutely. Thanks for having me.
Thank you. See you soon.